Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, New York City, we have James McDonald, CEO of Hercules Investments. We're going to talk about VolQ. That's the volatility index that tracks the Nasdaq 100. James, it's great to have you with us in New York City. And VolQ, you are no stranger to that. And 2021 is following 2020. Certainly a lot of volatility in the markets.
This is such an important product. And the reason it's so important is that the dominant source of gains in all indexes have been tech and have been Nasdaq 100 constituents. VolQ gives investors an opportunity to protect themselves from what we know will inevitably be a market correction. Markets don't go up forever, and tech tends to fall harder and faster than most other categories. And so what's great about VolQ is it provides direct focused exposure to protection for tech exposure. Tech is going to come down at some point, we all know, but we don't know when. A small VolQ allocation protects against that. What else I like about VolQ is it doesn't behave in inconsistent ways like the VIX does. The VIX tracks a medium-term futures contract, and so you may get inconsistent performance and inconsistent representation of your volatile exposure. Where VolQ is the front-month contract with the Nasdaq 100, it gives pure exposure to the inverse of the investments in those holdings when there's a dramatic move. We've seen that there's opportunities for Apple and Google and Amazon and Facebook and all of the healthcare companies attacking COVID to go sky high. At some point, this is going to come down. We love VolQ for protection against that.
And the instruments you're using are futures, of course, because that's what's available on VolQ.
Yes. And so futures contracts offer leverage, and they also speed as well. Futures are highly liquid, and what we like about the VolQ futures is that we can position ourselves in real time to protect against downside risk, and we can also take those positions off in real time. It's a very flexible product. Obviously, futures are not for everyone. This is not something that should be traded by individual investors. But as pros, we love this. It's a tool like a scalpel to protect a specific allocation in a portfolio. We've seen portfolios where 70, 80% of the gains of the portfolio come from 2 or 3 companies. Obviously, the Googles, the Facebooks, the Amazons, the particularly Apple Computer. These are all Nasdaq 100 constituents. And so if and when these stocks come down hard, VolQ should rise precipitously, offsetting that risk. And so we love it for that.
As a retail investor, I should still pay attention to VolQ, even if I'm not trading, VLQ, the futures. It's good to have a working knowledge of how it works, particularly if you have a tech-heavy portfolio. So retail investors should at least pay attention to the movement in it.
Right. It's a good point, Jill. You don't necessarily have to trade VolQ to benefit from VolQ. As we approach risk, we should see VolQ bottom out. And as we approach a potential pullback, we should see VolQ rise. And if we study VolQ overlaying with those names that I just mentioned, those FANGs, those big, strong, heavy tech names in the Nasdaq 100, particularly healthcare as well, if you study VolQ, you can use it as a barometer for the sentiment of risk in the market. And although it's not going to be perfect, it's going to give you clues as to how the sentiment behind the trading in those big names is going. And it's a way for it to be defensive, as you said, from an awareness standpoint, if not just traded.
All right, James, appreciate the insight. Thanks for joining us at Market Site, and thanks for joining me on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.